Hey, what's up, my friends? So welcome back to this month's price action analysis for October. Wow, time really flies. Okay, so just a quick overview, right? So for this type of video is where I share with you my thought process, my trading setups and opportunities that I'm seeing in the financial markets, right? I cover forex, stocks, and futures markets. So those markets that I see opportunities, I will just share them with you in this video, so it kind of help you reduce your learning curve, help you spot opportunities and whatnot. So without further ado, let's get started. So let's kick off with the FX markets. First currency pair that I want to share with you is the pound against the New Zealand. So big picture perspective, right? You can look either on the weekly time frame or zoom out on the daily time frame. It's up to you. You can see that this market is generally, I would say, is in a range to a wick uptrend. Why do I say that? Is that it's still respecting this long-term uptrend line that you see over here, right? Tested, forming a series of higher highs and higher lows, higher lows, higher lows, higher lows, higher lows. So the essence, right, for this pair is that as long as this upward trend line holds, right? Long-term view on pound New Zealand, I'm still bullish on it. Until the price can break and close below this level, then I'll be bearish. So since I'm still bullish on this market, the question is, hey Rayner, where do you buy? Right? Yeah, that's a good question. Where do we buy? So I like to, go down to a lower time frame to help me fine-tune my entry. So this way I have a smaller stop loss, right? And again, I can also see the price action clearly, right? That might not be visible here on the weekly time frame. So let's go down to the 8-hour time frame and you'll see something like this. So on this 8-hour time frame, again, if you look at the price structure, you can see that the price previously broke above resistance, right? And it tested previous resistance that became support, and now coming back here for a second time over here. So I have no idea whether this area of support is going to hold. But what I do know is that, number one, on the higher time frame, I'm still trading, right, along with the higher time frame trend. So that's one thing I know. Number two, I know that this is an area of value. So because it shows me that the price, right, has broke above this area of resistance, and it has tested once, and now it could come back for a second time. So what I'm looking for is for the price to retest here, right, and do a false break where the price, comes down to support and quickly, right, reverse away from support. So it quickly, bounce up higher, closing back above this area of support. So this tells me that the buyers are in control, they're stepping in, and hey, the price could possibly head up higher. So this could be in the form of a hammer, could be in the form of a bullish engulfing pattern, etc. So the faster the price leaves the level, the better it is. So for example, you can see this pattern over here, right? This is something like a doji pattern, came into the level and quickly bounced away, right? This is what we are looking for, a quick, swift price rejection. When that happens, right, I will go long on the next candle open, stop loss, right, 1 ATR below this lows. Okay, so for those of you who are not familiar with the ATR, it's basically an indicator that measures the historical volatility of the market. So let's say you pull out your ATR indicator, you can get it on this tab over here. And let's say the current ATR value is 100 pips. What I'll do is I'll find out what's the low of this candle and minus 100 pips. Let's say the low of this candle is, let's say, X. X minus 100 pips, which is the current ATR value, and let's say it's Y. So Y will be my stop loss. So for targets, right, so a couple of targets you can have a look at. For traders who just want to capture a swing, I would say the 197 area is a possible target, right, for you to capture a swing. So price could come down, do a false break, enter, and this will be your first target. For traders who are more aggressive and wanting to ride the move longer, the next possible target could be around this swing high over here, right? I would say before the 202 area level, right? So this could be your second target. So this is my take on pound New Zealand. Long term, still bullish on this market. Next one, right? Let's have a look at the euro against the Swiss franc. So if you look at this market, I just zoom out again with daily time frame. You can see that overall this market is in a downtrend. So if I have a choice, right, I want to be shorting this market. But if you look closely at this price action, you realize that over the last few months, euro against the Swiss franc is pretty much just within a range, right, between the $1 1084 area and this 1072 area. So really, buy low, sell high. What you want to do is you can buy near the lows of support and sell near the highs of resistance. So what you can do is, again, right, let's have a look, is that what I want to look for is for the price, again, to reach the extreme ends of support, right? Why the extreme ends of support? And this is because that will be, the so-called the best price you could get. That's number one. And number two is because when they trade breakouts, they tend to place their sell orders at the extreme ends of the range. So for example, let's say someone who is looking at this chart and thinking, man, Rayner, I'm looking to short this breakdown of this range. So where would this person put his sell stop order? well, probably the lows of this range somewhere here. So if the market just break down lower, this group of bearish traders, they will go short. So here's the thing, right? If someone is short, right, I want you to ask yourself, where will they put their stop loss? My guess, right, is that, let's say if this is the candle that broke down lower, they might put their stop loss above the highs of this candle. That's one. They might put their stop loss in the middle of the range. That's two. Or even at the highs of the range. That's three. So if you look at this cluster of stop loss here, here, and here, if you think about this, right, if you are short the market, your stop loss order is actually a buy stop order. Because if you are short and you need to get out of the trade, you need to buy back your position. Make sense? So your stop loss, right, is a buy stop order. And when the buy stop order is being triggered, that adds buying pressure in the market, right? Because if many traders get, stopped out at the same time, that will have a buying pressure in the market, right, to push the price higher. So this is why we have like so-called short covering, right? That term called short covering, where many traders are short. Then we have a huge spike up, right, in the market, right? That's because traders who got short, they get stopped out. They call it short covering in terms like this. So this is why you see a bullish a spike up. So same thing over here. So what I'm looking for is, again, my point is this, right? So I am not looking to sell the breakdown. Instead, I am looking to trade the false break, right? To profit from this group of traders who might get caught on this false breakdown. So what I'm looking for is for the price to head down lower, quickly reverse up higher, right? This time around, if it does happen, traders who are short, they are now trapped. So what I'll do is I'll enter on the next candle open, stop loss again 180 ATR below this lows, possible target before this area of resistance over here. So this could go both ways. You could do a false break near the lows of support, or a false break at the highs of resistance. Either way, I am perfectly fine to trade either direction. But as I've said, right, since the overall longer term trend is towards the downside, when it comes to trade management, I'll be more inclined to ride the move towards the downside compared to riding the move towards the upside, since it's against the longer term trend. Alright, so this is Euro Swiss franc. So these are the two currency trading opportunities to share with you. Moving on to stocks. Okay, let's look at stocks. So again, trading stocks, trading FX, right? The charts are pretty similar. Only difference is that in the stock markets you will see bigger gaps, right? Could be a weekend gap, or an earnings gap, etc. But again, price action is price action is price action. Trend is trend. So if you look at stocks, right, this is TRIL, this is Trillium Therapeutics. Zoom out the chart, again, same thing, right? Market is in an uptrend. What do you do in an uptrend? You look for buying opportunities. So again, the question is where do you look for buying opportunities? So before we begin, right, let me just share with you how I trade stocks. When I trade stocks, I like to buy the strongest stocks out there. I don't want to buy cheap stocks. I don't want to buy stocks in downtrend. I only want to buy the strongest stocks out there. Stocks which are in nice, healthy uptrend. These are stocks that I focus on. Reason for it is that in the long run, stock markets, they are in an uptrend, and I don't want to fight against this long-term uptrend. So I want to put the odds in my favor and only buy uptrending stocks. I don't short, I only long. So few things to look for. Number one, looking for the strongest trending stocks out there. What you can do is to find is just pretty much just pull out the indicator called the rate of change indicator. Okay, and you can look at the weekly time frame, and look, I usually go with a 50-week ROC. So basically the stock price movement of almost 1 year. And I like to buy stocks, right, that has a high ROC value. The higher, the better. So in this case, I'm not sure if there's a typo over here. There's 6,000, I think. Yeah, I'm not sure if there's a typo. Maybe there isn't. Maybe it's really 6,000%, right? But as I've said, right, I like to buy the strongest stocks out there. The higher the ROC value, the better. And the ROC value has to be higher than the S&P ROC value. So meaning if the S&P is up 10% this year, the stock has to be up more than 10% this year. This tells me that this stock, right, is stronger than the overall stock market. Okay, so anyway, TRIL. What I'm looking for is, again, you can see over here, we saw that the ROC value, it's pretty nice and strong in almost 6,000% this year. And again, I'm not going to buy just because this stock is in an uptrend. I want it to come to an area of value, right? Give me a valid entry trigger. This way I can manage my risk, setting proper stops, proper target. So what I'm looking for is, again, area of value, I would say, is over here at this swing low. This could be an area of support, swing low, etc. Waiting for the price to come down lower, swing down lower, and do a false break and close up higher for the day. Enter the next candle open, stop loss again 180 ATR below this low. So for possible target, right, depending whether you want to ride the trend or capture a swing. If you want to capture a swing, right, I would say before the $16 price point is a possible area to take profits. But for me personally, when I trade stocks, I like to ride the trend for as long as possible. So what you can do to ride trend, you can use a trailing stop loss like moving average, percentage change in price, etc. So I'll talk more on that on the next stock to cover, which is this one over here, LVGO. Okay, so this one is again, right, instead of again, same concept, zoom out your charts, you realize that this stock is in a nice uptrend. Right, if you pull out your rate of change indicator, I can assure you this is definitely, has increased in price, right, more than the S&P 500 over the last 50 weeks. So now we are looking for a valid trading setup. So this time around, right, the setup is instead of trading from an area of value, I'm looking to buy the breakout of these highs, which has actually kind of happened, right? The price has actually broke out of these highs. And if you look at the closing price, right, it has closed the highest price point, right, over the last few months or even years. Look, close at this highest price point. Okay, so I'm looking to buy on the next day's open when the market open. As for stop loss, right, what you can do is you can adopt a trailing stop loss technique. So for the stock markets, I like to go with the 30% trailing stop loss. I find that that's kind of like the sweet spot. The stop loss is not too tight where you will get stopped out on the pullback, right? And at the same time, right, it's not too long, right, where, the reversal comes, right, and you could, it's not too long, right, where you have to hold this trade forever. So this, to me, 30% trailing stop loss, for me personally, is my own sweet spot. So how do you use this, right, is that, let's say, the stock now, let's say, assumes at $150 price point. You buy at $150. So a 30% trailing stop loss, what you'll do is calculate, right, what is 30% of this price, of this $150 right now. So you can see that 30% of 150 is about $45. Okay, so what you want to do when it comes to trailing stop loss is just identify the highest price point and multiply by 30%. Find the 30% value of it. So 30% of $150 is $45. You take $150 and you minus off with $45 and you get $105. That is your trailing stop loss. So 105 is somewhere here. So this means if the price, let's say, it breaks out, comes back all the way down lower and close below this $105 price point, you exit the trade. And let me give you a shortcut, right? So for those of you who suck at math like me, right, how do you get this number quickly? You can just take the highest price point, in this case, let's say it's 150, multiply by 0.7, and you will immediately get this $105 as well. So just kind of save one step. Okay, so let's say right now if the price moves up to $200, let's say it goes up to $200, where is your trailing stop loss, right? You will shift your stop loss higher, and in this case you just take 200 multiply by 0.7, you will get $140. So your trailing stop loss now is at about $140 here. So let's say the price goes up higher, right, to $200. Imagine here is 200, and if you trace back all the way close below $140, you will exit the trade. So that's what I mean by using a percentage trailing stop loss. Of course, this percentage you can adjust it to your preference, whether you're on 20%, 10%, 40%, etc. But for me personally, 30% is my sweet spot. I don't get stopped out on the short-term pullback, right? So this kind of like allows me to ride the move longer, to ride the trend longer. So yeah, this kind of like the setups that I will share with you for this month. And by the way, if you want to learn more about price action trading, you find that this trading methodology resonates with you, then get a copy of this book called Price Action Trading Secrets. Right, this is a 140-page color trading book. There is color on every page, right, where you'll discover proven price action trading strategies to profit in bull and bear markets. We talk about reversal trading, breakout trading, support resistance, candlestick patterns, risk management, position sizing, and so much more. It's 140 pages of content, right? So if you want to get your hands on it, right, just go down to the website priceactiontradingsecrets.com, right, and you can get your copy over here. And along the way, I'll send you a few bonuses, like giving you a ebook version of it if you want. I'll give you my own proprietary position sizing calculator, as well as an exclusive training webinar. So all this and more right over here. So with that said, I wish you good luck and good trading. I will talk to you soon.